But we begin today with our top story. The Bank of Japan shocked global stock and bond markets overnight in a surprise shift in its policy stance. The central bank widened its cap on 10-year Japanese government bond yields, allowing it to move 50 basis points in either direction of its 0% target, up from 25 basis points previously. Here to break down what this all means and why it's important is Francesco Pesole, ING FX Strategist. Francesco, good to see you here this morning. So what does it exactly mean for markets around the world?
Well, there are some direct implications and some indirect implications of the Bank of Japan surprise move. The direct implications obviously are on the yen and the FX market. The yen is trading around 3% higher after the announcement, and it's really, there's a chance that this has opened the way for more appreciation of the yen from now on. There are some indirect market consequences that derive from the fact that now markets may start to speculate more on monetary policy normalization in 2023 by the Bank of Japan. And given that this had been a benchmark for kind of keeping rates at check, this can have broader implications for other bond markets, and this is surely not very good news for equity and risk-sensitive assets. So these are the key parts that we're seeing being impacted at the moment, but we really need to see how this progresses in the next year.
The bank itself is not portraying this as tightening, but the market is viewing it as tightening, right? This action. And we are seeing a downward move in the dollar yen, right? And I wonder if one of the implications that we could see is a further hit to what has been this extraordinary dollar run.
Yeah, definitely. The dollar run has been largely a consequence of the Fed in 2022, the Fed being very hawkish and surprising markets on the hawkish side until markets kind of assessed that 5% would be the terminal rate approximately. Obviously, some currencies were hit by the Ukraine war and energy crisis, and the Japanese yen was partly hit by the energy prices, but at the same time it was very hardly hit by the fact that the Bank of Japan was staying very dovish while other central banks were raising rates. So this indeed is one of the factors that looking at the next year may suggest that the dollar recovery, which we expect to happen on the back of some unstable risk sentiment, especially in the first part of this year, may not be as pronounced as we and other kind of dollar bills would expect to be. So yes, this is definitely an option. But we'll need to see, as you were saying, the Bank of Japan said this is not monetary tightening. But when you make such a big shift, markets will inevitably speculate this is monetary normalization, at least. So they will need to, it'll take a lot to convince the markets that it's actually not.
With that market speculation, the markets, at least here in the U.S., have looked really closely at the terminal rate to get a sense of how the U.S. Fed is going to act. What's the kind of analogous metric or benchmark that we should be monitoring in Japan?
Well, first of all, we need to see whether they are willing to allow kind of the band, the tolerance band for 10-year government bonds to go even higher than the current 0.5 percentage point. We must remember that the outright target is still 0%. So they allow a plus 0.5% to minus 0.5%. Obviously, in the current environment, rates go to the 0.5% level. So this is the first level, and then we need to see whether they effectively start withdrawing some of the monetary stimulus with higher target rates. So there's a lot of things that they can do. We must remember in April we'll have the change in the government of the Bank of Japan. Kuroda will step down. So this is also very relevant because we could see a complete change with the new governor potentially.
Yes, and that's something that the markets are also trying to consider. Something else that's a part of this story is Japanese ownership of foreign assets, which is relatively high. We're showing a chart of that as a proportion of Japanese GDP. So if indeed there is tightening or continuation of what appears to be this big step here, what implications does that have for that ownership?
Well, this it's a very interesting topic. Also from an FX perspective, should Japanese assets become more attractive from a yield perspective at a time when markets are still not fully convinced to get back into riskier assets like equities, given market instability and still tightening by certain central banks into a recession, then we could see kind of the attractiveness of Japanese bonds become much higher in this current environment. And just looking at the FX perspective, this would also mean more inflows supporting the Japanese yen and probably going against mostly the dollar and the euro.
ING FX strategist Francesco Pesole, thank you so much for joining us this morning and breaking this all down.